in software, recurring revenue business, right? It's subscription based. Retention is the name of the game.
Hi everyone. It's our next episode of our SaaS and Tech interviews, and our guest today is Kjael Skaalerud. He is the president of Skaling Ventures, and he knows everything about acquiring and operating micro-SaaS companies. Hi Kjael, how are you doing?
Hi Natalia, I'm doing well. Thank you. Thanks for having me. I don't know if I know everything. I might know a small bit or two, but yes, thank you for having me.
Don't be shy. Thank you for joining. Well, obviously, we're going to speak about SaaS today and about acquiring and everything what is going on the market. And I know that we had to shift our interview a week later, just simply because I know that you were closing some deal. You just let me know that you're acquiring another company and you're finalizing all the acquisition last week. Could you please just share what was the deal, what was the process, and let's maybe use it as a case study straight away.
Yeah, for sure. So we've decided, like, I guess I'm a big advocate of building in public. So I actually have a Substack for the love of the game, which is kind of a cheeky name, but it's been kind of just me documenting our journey into micro-SaaS. And for those that aren't familiar, I guess conventional software buyouts usually start at 5 million to 10 million in recurring revenue. That's where kind of the traditional lower middle market firms play. And micro-SaaS is kind of an order of magnitude smaller than that. So think companies that are generating $500K to $1 million in ARR. So lower middle market, you might say. So micro-SaaS is kind of its own flavor of buyouts. And I chose to take this path after I was formerly a CRO at a private equity sponsored, or I was a PE sponsored CRO at a private equity owned firm. And we grew it and sold it to another sponsor. And I had the opportunity to kind of stay on that path and continue moving up market. And that's when I decided, I think micro-SaaS and I guess the category in general has been just pushing into the consciousness of the SaaS faithful, if you will. People like me are just kind of seeing it more and more. And there are marketplaces like acquire.com and others where you can really get kind of interesting visibility into deal flow. So I was following micro-SaaS for a long time. It's like, this is very interesting. I was about to kind of have an exit and come into a small amount of liquidity. It was like, all right, how can I kind of actively grow this capital? And so I decided to go, I guess, as cliche as it is, kind of take the path less traveled. There was a fork in the road, and I was like, I want to try this micro-SaaS thing and try a derivative of private equity and maybe do it on my own terms and do it with a team that I've grown to work with over the years of contractors and consultants, etc. So long story, but that was 6 months ago. I kind of made the jump into this, and I was fortunate enough as well to have a financial backer. If you're familiar with like a search fund, now, I don't want to throw too much jargon at you, but I basically had somebody that was like, hey, Kjael, I'll back you to get this going, and I'll cover your income. And it's a firm called Halbar. So he kind of put me in a position to go try this and attempt this. And that was 6 months ago. And so I was very familiar with operating. I was, I guess I had been a CRO, I had been a venture-backed VP of sales, et cetera, but I had never been on the buy side of a transaction. I'd been on the sell side of a transaction. So I was like, okay, I need to come up with, processes and systems and think about due diligence and what am I actually looking for in a company? Like, what are the attributes that make a company attractive? And then you can kind of inform a thesis from there. But obviously I'm very kind of systems oriented. I always joke, you don't rise to the level of your goals, you fall to the level of your systems. So right out of the gate, I wanted to make sure that we at least had something that was highly documented and that we could iterate on. And so fast forward, the first quarter was like, am I ever going to find a business? Am I ever going to do this? Am I ever going to acquire something? Is it hard as everybody makes it out? Of course, you like I always say, you want to at least, like, I guess the perfect kind of ratio is 60% total comfort zone, 20% you're stretching, and then the last 20% is like staring into the abyss and you're terrified. So I was probably running at like maybe not that ratio, more terrified than I'm typically used to, but that's, of course, where the growth happens. So anyway, long-winded kind of way just to set some or give some context to the audience. But lo and behold, last week we closed our first acquisition. So and we're, I guess, building in public, and I'll continue to kind of document our thesis and what we're, I guess, going to approach it. I guess, kind of OKRs, just probably more under the hood than people are typically used to seeing. But we're going to maintain some anonymity. So I'm not going to name the firm, but I'll tell you it's a business management, because, it's like, I don't really want the world to know what we're doing, and I think a lot of times that's the only time you hear from private equity fund managers is like they just announce deals, right? I mean, that's basically their only activity on LinkedIn. I'd like to kind of move in silence, and share a lot about what we're doing, because I think that there's a lot of people like me who are operators who want to maybe jump into this world or just want to learn more about it. So anyway, to give what detail I can, it's a business management platform for creatives. So things SMBs, small businesses, mid-sized businesses, SMBs. So figure 1 to 5 employees, a lot of solo practitioners, and they participate in kind of creative domains. So photographers, event-based professionals, etc. And I guess, well, what stands out about it? I mean, I think it's kind of a very textbook story where it was a founder, and I know that you wanted to touch on where the founder or the seller and that DNA fits into a scorecard. And I think that's an excellent question. But this was a very cliche story where the founder was playing in the category. He was also a software developer. And so he started to build tools for himself, which is a very common kind of entrepreneurial trajectory. And then, or eating his own dog food, so to speak. And then it started to really catch on, and he had a peer group that was in the category, and it was like, hey, what are you using for this stuff? He's like, something that I built. And then all of a sudden it just kind of grew organically. But, you fast forward a number of years, and he's the lead web developer. He's the head of customer support. He's trying to market the business when he can. And so it kind of gets to that plateau. And over a number of years too, obviously folks start to think, hey, I'd like to kind of take my chips off the table. This has been an incredible run. I'd like to go explore other things. And so this was that kind of situation. And in terms of like what we look for, and I know that this was another topic you wanted to touch on as well, is like in SaaS, there's always a conversation around acquisition versus retention versus expansion revenue. And so, and I'll definitely elaborate more on this, but the thing that really stood out to me in the business, and I think probably the thing that stands out to most people in my shoes, is really around retention. It's like, hey, if we have 100 customers at the beginning of month 1, how many customers of those 100 customers do we have at month 2, right? And it's like, ideally, you're looking for 98% retention or above if you're selling to small, mid-sized businesses. And so he was north of that from a retention perspective. So that really speaks to the utility of the product, the efficacy of the product, the loyalty of the customers, and you can build growth on top of that, right? It's when you have a really leaky bucket where you're churning, 10, 15, 20% of customers month over month, it's very hard to sustain growth. So
I also heard about you that on some of your interviews that you're fanatical about crafting go-to-market strategies, and you just, as I mentioned in the beginning, you know everything about acquiring, retention, about expanding. So from your experience, on which stage founders, companies have the biggest problems? Which stage is the most troublesome?
Gosh, I mean, the context is really critical, and I guess one way to simplify or generalize the context is which stage business you are. And if you just think about like a typical trajectory, if you're kind of pre-revenue, early revenue, and then you could say, seed, Series A, Series B, but I think to be more specific, it's like, hey, is the business generating revenue? Or you're kind of product market fitty. Cool. Now you've got your first cohort of customers. You've starting to transition towards like a repeatable customer acquisition model. And that's usually transitioning away from founder-led sales. So it's like, hey, the founder's running around just telling the truth about the business and why he did it. How do we kind of replicate that pitch in a certain way that's authentic and start to implement a sales team around it, et cetera. And then you kind of get into, we have all these customers, how do we continue to grow, but how do we retain our customers? And then how do we expand kind of our relationship with them over time? And I guess these are kind of, if we take that context away and just try to generalize an answer across the board, I think, acquisition is like the sexy thing, right? It's like new users, revenue growth. What does that look like? And I think it's very romanticized, like especially in a lot of sales cultures, like you want to be a hunter, right? You want to be responsible for new business versus a farmer. And the reality is, and there's some interesting charts, and I've actually written about a few of these in the past, but if you just think that, hey, we want to grow by 20 new customers a month. and we want to keep, and customers a lot of times, and this is kind of counterintuitive, is like a number, right? Because there's diminishing returns to customer growth too. Like maybe you find a honeypot of all these perfect fit prospects and bow, you have a big month or something like that. But over the long run, it's hard to acquire the kind of same consistent level of customers. And if you think about retention, is usually a percentage of the whole.
Mm-hmm.
So as your customer base grows, right, it's harder and harder to keep 98.5% or just even 100%, right? It's like, hey, we have 100 customers. Okay, it's pretty hard to keep 100 customers. We have 1,000 customers. That's a lot harder, right? And
even harder.
Or 10% of 100 is 10, 10% of 1,000 is 100. So the challenge of retention scales geometrically as your user base does over time. And so I guess to answer very simply, retention is the name of the game, period, in software.
Cool. You already started a bit on that. When you do a screening process, when you pick a company, you have criteria. You just look at, I don't know, ARR, revenues, and all of those data and metrics. But you personally, do you have a founder's criteria, something that you also pay attention when you talk to people, not actually screening the business, company, and those business attributes itself, but just looking at the founder and understanding like if it's going to click, if you would like to work and cooperate with that person, or it's not that much important and business just goes first,
Yes. So I wish that my answer wasn't the way that it is, because it's like you want to be you want to be like this Ray Dalio human that has this scorecard that kind of has an algorithmic translation, and it's like, hey, we looked at all these things and the score was this, and if it's above this, let's pursue the deal, right? And I was trying to get to that, and I think that's where a little bit of my naivety or me, this being kind of my first rodeo, was exposed, because the seller or the founder is absolutely mission critical. It's so important. Like you can almost kind of throw the scorecard out the window. And I think, well, I mean, obviously there's kind of some stuff where it's like, hey, you have to achieve some base case score, right, to have the conversation. But then once you're in there, a positive conversation with a founder can really change the dynamic of everything. And there are a few reasons for that. And this is unfortunate because this is where it's less science and more art, or like the conversation around gut or instinct comes into it. And you hate to hear that, because it's like, all right, how do you repeat gut or instinct? How do you train somebody on gut or instinct? How scalable is it? Right? Yeah. And it's like, oh, it's your secret sauce. And at the end of the day, I think that's what makes us unique, and that's what makes us individuals. But in the context of our most recent acquisition, so there's been some interesting, I guess, thought around this, and not so much research, just content around the notion of a founder market fit. And it's kind of, and it makes sense, right? It's pretty intuitive, and it's like, okay, like how intimate is the founder with the market that they're serving? And is it the case that they were participants in the market? And so I guess the argument is like, if the founder has really unique empathy for the category, empathy meaning they understand the users, they understand the pain points, the likelihood that they'll build something relevant goes up. So I spend a lot more time now digging into the founder's background. And there can be kind of you came from this market, therefore you understand it, therefore you've built something that's unique. And that was kind of an asymmetry in your vantage point, right? That you could exploit. Another is if they're repeat entrepreneurs. So that means that very likely, like, they're very good at seeing something in the market and executing their brains out to take advantage of it. And then once they get it to a certain spot, they move on to the next thing. The type where they just see that stuff and then they go. So if you come across somebody like that, you can feel pretty assured that, okay, this is a professional who moves quickly, et cetera. So those are a few, I guess, DNA components where it's like, do you come from the category? Do you know it like the back of your hand? Or are you just really elite at building software at spaces where it doesn't exist? The other one is, it's like a reverse marriage.
Tell me more about that.
It's like you kind of come in and it's like, hey, like for a month we're married. for the next month after that, we're engaged, and then after that, we're just kind of dating. So it happens backwards. And actually, that's really funny because I've never really thought of it that way until now. But and you have to trust the founder, the seller, because it's not the case where you sell a house, right? And it's like, hey, buddy, house is yours. Throw him the key. Have a nice day. In this situation, the business is alive. There are customers, there are transactions, there are processes, there are concerns, there's all of these things that are moving, that live and exist, right? And that continue to persist. So if you don't want to set up a situation where the seller's like, hey, business is yours, have a nice day. Like, you need a guide to be like, hey, there's some really weird shit in that closet. That's where a lot of the bodies are buried. That stove over there doesn't really work. Like, be very careful when you turn it on, or you'll blow your eyebrows off. And you need that context. So I go into it much more now of like, I'm generally partnering with this person, at least for a quarter, right? And the success of that transition is completely dependent on my level of trust with that person. Right. And then it just becomes down to like a colleague kind of conversation. It's not like you interview them and you would screen them for competencies, but it's like, is this person going to be accountable to a binding agreement that says this is how the business is going to transition? Am I going to enjoy my time with them? And then I think what's very unique as well is that most of their skill sets, right, are the exact opposite of mine. So they're developer first. They are builders, they create products, and they understand go-to-market such that, they can get one channel going, which is usually we have this small cohort of totally rabid customers, and they talk to their peers. And so it's like, are you buying any ads? No. Are you sending any emails? No. It's like, how are you growing this business? Like, people come to our website and buy the software. It's like, wow. It's like, that's very rare. And it's like, but that only scales to a certain point, right? You kind of have one channel going. So people like me come in, and it's like, okay, we're all about lighting up as many channels as we can. And the skill set is about growth, right? So there's an opportunity in micro-SaaS where those skill sets can converge, and the person who got it to this point can be like, hey, I'm handing you the reins, but at the same time, I'd like to, you can stay on the cap table for some equity. You can, there's ways to make it interesting where they can take another bite of the apple, so to speak, and continue to ride the ride for that next wave of growth. And I think that's just in everybody's interest. It's like, why would you want to completely walk away from something that you spent many years of your life and tears and blood and sleepless nights and all that stuff, and just hand it off when there's an opportunity for kind of new energy, new thinking to come in and maybe take it to a new place? So now the person in the selling role of a business that I'm trying to acquire is of absolute critical component. And it usually boils down to like, do I believe they know this market better than anyone because they've participated in it, or there's some other reason? Do I think that they kind of are serial in their ability to do this? And do I want to partner with them for the next 3 months to take ownership of this business and make sure that we don't lose anything, that it's all purely movement in the right direction, and then perhaps partner with them in the longer run?
Right. Awesome. Reverse marriage, that's funny. That's something definitely memorable. Great. It's known that PE and VC industry is generally like defining and understanding everything that is, they are upfront, and everything what is happening in the market, they are defining the flow. As you actually mentioned, they are intelligentsia that defines the capital and talent flow. So intelligentsia is known for seeing and defining things that are going to happen in the future, that are about to happen in the future. Can you name some of your predictions for upcoming years when it comes to the SaaS growth and capital movement that you personally expect to see?
Yeah, wow, that's a big question.
I'm not asking you to be, an Nostradamus and give us I see that is gonna be, but something that you already see some seeds of, and is just reading trends.
Yeah, for sure. So I mean, and I don't want to, I guess I want to say have a few perspectives that are unique, because I think everyone's like, hey, there's a big correction in valuations, especially for SaaS companies, where and that was just a blip in the trend line that we can't rationalize, that will never come back, right? It's like, hey, this company's trading at like a 20x forward, right? It's like, hey, we think we're going to make this in the next 12 months trading at a 20. And it's like, like typical days are you trade on the revenue you generated in the last 12 months. And, the 10x was a really healthy margin, or a really healthy multiple. So obviously valuations are rationalizing, especially in software. As cost of capital is going up, interest rates are going to go up. So that has a big impact on kind of the risk-free rate and the type of returns that people like me need to generate. Because it's like, hey, I think probably land around 5%. It's like, the risk-free rate is 5%, and that money's generally kind of liquid. If I'm going to give you my money for up to 3 or 4 years, and there's risk you don't give me any money back, I need at least a 30% return, right? So those things are all very kind of interwoven. But generally speaking, I think, and then if you look at kind of like, all right, the value chain of like venture is power law, right? They're going to put 100 bets out there, and 20 are going to generate the results that they need across the entire fund. And it's their job to prop up new categories and capitalize, plant a bunch of seeds, right? And just pray that some grow, or knowing that some will grow to be category leaders, and they'll push new categories forward. And that's where a lot of innovation happens. And then private equity comes in, usually more in the context of like, hey, we're going to take a bunch of leverage, a bunch of debt, and acquire this company. And then we're going to consolidate this company with its next 2 competitors. And that's where the playbooks are much more prescriptive, but it's less kind of experimental. And so micro-SaaS is kind of interesting because it is private equity, and it's more akin to kind of like these buyout scenarios, but it's at way down the value chain, where you would typically see kind of Series A companies as a measure of revenue. It's like, yeah, they're doing, $500K in revenue. And it's like, okay, we would pile money in and try to grow it because we think it can, attack a huge addressable market. We think, there's a lot of things that kind of go into that factor. Whereas in micro-SaaS, that's not the status. It's like, hey, we're going to acquire this business that's highly profitable, and we want a 2 or 3 exit and kind of get it into that tier, $1 million in ARR, $5 million in ARR, whatever it is. We'd sell to another financial sponsor, or we just hold the asset and it just kicks off cash, and we invest keeping it relevant over time. So, I mean, I think when I think about capital allocation, and I guess my purview is a little bit interesting too, because in my former role, I was selling software to fund managers, and I didn't lack the context because I hadn't lived through economic cycles in that role. So it was just gangbusters. Like allocations to alternative investments were absolutely ripping. So it used to be, alternative investments, right? That name, the name itself, right? It was like private equity, venture capital, real estate, there's a couple other derivatives in there, but alternative assets used to be labeled that because they were alternatives. So in a typical portfolio, they might have made up to 5, 10% of their total portfolio. And if you look at, huge pensions and sovereign wealth funds, alternative assets were now 30 to 50% of their allocation, right? So all this money was going into private equity, private assets, however you want to define it, whether it was a venture play, et cetera. So I think that's probably going to pull back just a little bit because there was kind of a buzz, and that generated a lot of first-time managers, emerging fund managers. We're going to maybe struggle to generate an interesting return in like the 22, 23 vintage. Like this could be a tough year for funds. But generally speaking, I mean, I think predictions on the table. I think alternative assets are here to stay. I think if anything, it's becoming more democratized, which is a lot of what the success for my thing is, right? Like it's like, hey, do you want to invest in Skaling Ventures? It's a 2 to 3 year hold time, and we're going to generate 40 to 70% IRRs, and you can see under the hood at any time, and you're going to get monthly updates with actual financials and stuff like that, versus a typical private equity fund, which is a 10-year hold time, a minimum check size of like 500 grand, and you don't get visibility into anything, right? So it's like not for the common human. And there's other concepts like sweater ventures out there, et cetera. So I think alternatives are here to stay. It's going to become more democratized and kind of derivativized, and people are going to have access to it in different ways, just like everything, right? Everything gets democratized over time. And I think that's really exciting because micro-SaaS is a very interesting flavor that allows people like me to play in the space, that allows investors to get access into the space. And then I would be remiss if I didn't mention, I mean, obviously everything that's happening with these, generative human language models and big MLL frameworks. I mean, ChatGPT has totally changed my work on a daily basis, especially due diligence. Oh my God. It's like, hey, how big is the industry back to our landscaping? How many landscaping businesses are there in the United States and at what rate is it growing? And it's like, blah, 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 and that used to be, you'd have to buy an industry research paper for that. Or who are the top 10 software providers in this category and how would you describe their value proposition? How would you segment the market? And this is the first time, and I was always a big, I understood decentralized everything. Like I saw, I was in New York City when Bitcoin landed real hard, and it was like, yeah, this makes sense. Like obviously a digital currency is going to probably be an evolution of a fiat paper currency. Everything else is being digitized and I could follow it, but there was just too much kind of friction for real mainstream adoption. With this one, I'm literally my high school nephew. I'm like, hey, he's got a business idea. I'm like, hey, this is your assistant, or my mom, hey, you're planning a trip to Italy. This is your assistant, and it's a chat window. So I think GPT is definitely like a platform kind of new layer that's getting added to the infrastructure of society, where if we had kind of compute and then the internet and then mobile, I think, generative AI is going to sit on top of that. And it's not, I don't seem that it's threatened, but for me, it's like, we're pulling that. It's like, the warriors that win the war have the best weapons. Right. And so if you look at it, it's like, this is just raw operating leverage. So do we incorporate it in our, and I'm not running at, startup concepts that way or thinking about acquiring companies that are doing this, because that's very kind of lemming setup, right? Because now everybody has AI somewhere in their business, right? They know that that's what investors want to see. So it's like, oh, this is a ChatGPT thing that does this thing and it's great. Yeah. And it's like, does it really? Or is it just, traditional software? But for us, it's mostly about like, how do we, and there's going to be huge capital that just absolutely pours into that, right? Because they're like, hey, this is basically a platform shift like the internet. We're going to bet on 500 search companies under the assumption that one will be Google, and happy days, right? We know that there are going to be some $1 trillion winners here. So venture, that's going to definitely, and that'll probably offset a lot of the cooling around software and, valuations and the layoffs and et cetera. So that's going to happen. But for us, in the micro-SaaS world, it's just like, how do we get leverage, and then how do we plug this into our business models to make them more profitable? Because we're not like a growth above everything. We want profitable, healthy businesses. And so one application is like, we're about to refresh our customer support function. And it's like, instead of writing all this content, it's like, why don't we take all the support content that's been written, train a model on it, and our entire support function will just be a chatbot that is powered by this huge model that is ChatGPT or GPT-3, and we'll API in, and then we'll train it on all the content that's unique to our context, and the user will just interact there. We don't need to write anything. We don't need to build anything. So that's like a quantum leap. And that, saved us 100 hours of work, maybe more. So stuff like that is like, pull that into your world and take advantage of kind of the investment that's been happening from institutional players, and maybe think less about, I want to acquire these companies or I want to invest in these companies, and more like, how does this stuff give me leverage today? Like today, what am I doing? And can I can I basically outsource any of my activities to this new emerging technology that is going to be a game changer?
Yeah. Thank you very much. Thank you for your prediction. And I'm looking forward into the future just to see how the world will change. And let's move to our rapid fire questions. Rapid fire.
All right. Let it rip.
Yeah. So your biggest regret?
I wouldn't say, and I'm grateful because, I think one of my regrets was that I didn't come up with a calculus for happiness that was my own. I inherited society's, or Western culture, American culture's definition of success, which was money, material possessions, more, right? And I think we're all kind of having like a spiritual, like, oh shit moment where people are waking up that are like, I went to Harvard, I was an investment banker, I have a house in the Hamptons, and I'm miserable because I never kind of did that calculus. And it's like, all right, for me, what's happiness? Like one like really foundational thing is having a chance to take a walk with my son, and we've got like the little baby carrier and my wife, and I can do that every day, right? And then it's like, okay, like what is that worth to me in terms of money? I'm like, that might be worth $10 million a year, right? So I never kind of paused. I just kind of was like, New York City, go to a top 10 business school, be an investment banker, be a management consultant, wear the dope suits, drive around in fast cars. And it's like, no. Like, you actually need to think for yourself and be like, what makes you happy? It's like, well, I'd like to go on one really great ski trip a year. I'd like to have a family dinner. I'd like to learn an instrument. I'd like to read books every morning and have a cup of coffee. I'd like to go to a cafe every Friday and visit with a different friend a week, or whatever. But once you start to do that stuff, and all of a sudden it's like, okay, wow, shit, I'm happy now. and you might be making less money or, whatever, but the happiness kind of factor is an equation that you have to come up with. And I regret that I didn't do that work earlier in life.
Wow. Beautiful. Thank you very much. It's always nice to have a house in Compton's, though.
That's it. And a helicopter that takes you there.
Not related. Well,
totally.
Denver or New York?
Oh boy. Well, you know what? Because I think my son,
just one.
I think my son is gonna ask me this. I would say New York. Rule number one is you go where the action is. So I think New York is one of the most exceptional training grounds in the world. Like, it's just condensed. 1 year in New York's worth 3 or 4 in another market because it just moves fast. Outside of that, I think I was there for 10 years, and I think past like 5 years, your sanity is just like in structural decline. Like, it's just like, I swear it was like, maybe it was just every time my mom would call me, and it's just like, boom, there's a siren, boom, here's like a crackhead screaming something at me. And she's just like, how do you live with all that stimulus?
And you were like, hey, that's my normal Monday.
Yeah, I was like, Mom, it's Tuesday. I'm walking home. I just got off the subway. So I think, and then and this is kind of funny, right? It's people are like to look back 10 years ago, and I'm like, wow, it was a different time then, though. Like, I remember on the subway, this was 2011, I guess. And like, iPhones had just landed so hard in New York. That was one of the first observations I made. It was like, wow, every single person on this subway has an iPhone in their hand and their head is down. So I think information flows now much more, and it's like, just fast forward kind of the internet mobile age, 10 years. And so I think you can make up not having geographic proximity to New York now better than you could back then. And so if I blend that into the equation, I think Denver for sure, but I love to ski, and I love sunshine, and I love being outdoors, and I like being close to my family. But I already did my duty. I already did my tour. I already did my 10 years in New York, which turned me into a 60-year-old man spiritually. But so it's, but I think mentally. But I think gun to my head, I would say Denver is definitely my preference, but it's hard to remove the bias and the context and everything that got me to this point.
Awesome. If your son, your cute little precious creature, come and tell you that he wants to be a president of a VC, what would you advise him?
What would I advise him? Interesting. And I think a lot about this, honestly, because, I'm a product of a liberal arts undergrad program that taught me to be social, gave me a chance to travel Europe. I created some lifelong friendships, and then I participated in, I don't know what Stern is now, but a top business school in New York City. And you get to the end of it, and it was, like $160,000 or something. And you start to wonder, and obviously there, everyone knows that education and healthcare, all you need to do is look at, all right, this is what inflation looks like over the last 20 years, and this is how the price of education and healthcare has gone. You go, whoa, something's wrong. Like, unless the quality of the good or the service has 10x'd in that period of time, which we know it hasn't. It's the same lecture halls, and half of them, the syllabus is 5 years old. So it's like, it's arguably out of date, right? So I think a lot about like, what's a modern way to educate a human, or to position them with like, hey, and I think if you just think about it simply in terms of resource allocation, It's like, all right, do I want to, and I want to, my intention, I think a core purpose of my life is to give my son a level up. You don't want to make his life easy and take away the struggle, because, you know, that's iron is made in fire, right? But you want to give him advantages to a certain extent where he's not starting from the same yard line. And it's like, all right, 160 grand in educational fees, or you want to be, you want to kind of think about dad's path. How about this? Here's 5 grand. And tell me what you would do with it. Are you going to buy an ATM and put it in this gas station up the street that you know has a ton of traffic and no ATMs? Are you going to start a lawn mowing business with your buddies and you're going to rent the lawnmowers? Are you going to, you know, be a lifeguard and put the 5 grand in, you know, some stocks that you find are interesting?
Mm-hmm.
So I think a lot of it is like us treating, especially as a kiddo, right? Like their number one job is process of elimination. It's like, hey, your job is to go find as much stuff that you don't want to do as humanly possible. It's like, because right now your aperture is like this, and it's like, don't want to be a doctor, thank God. Don't want to be a lawyer, cool, okay, you know, and like, because that you're never gonna find the thing, because everyone's like, oh, you know, what do you want to be when you grow up? And it's like, dude, that's a lie.
Yeah,
it's
you
like
end up with a pool of things.
Yeah, you iterate your way, and then, oh, you know, shit, life happens, and you got to kind of continue to define and reinvent yourself. So I think if he came to me and was like, hey, I want to get into this private equity venture stuff, and I want to, you know, acquire companies and operate them, I think the first thing would be, cool, let's see you operate a business, and let's see what you do with 10 grand. And then, you know, if it gets to that point where he's like, I'm jazzed, and then it's like, and also, son, you know, you need to be aware enough to see the feedback loop. Like, how are you measuring your performance? How is your performance compared to your peer group? Like, how are you performing against some kind of base rate? Are you seeing a rate of improvement over time? Like, what evidence do you have that you could be elite in this domain? And let's just continue to experiment together. And I'd gladly rather give you money to do that than to go learn some shit you'll probably forget twice. You'll probably have to learn and forget this stuff twice in your life, and I'm just not down with that anymore.
Wonderful. Well, Kjael, thank you very much. That will be it from my side. I have no more questions. There was a great pleasure for me to have you. Thank you.
Likewise.
Thank you for your time. Appreciate it.
Likewise. Thank you so much, Natalia. This is a great time. This is a blast.